Thinking of closing up shop in California? Well, let's dive right in. Welcome to this explainer where we're going to walk you through the precise step-by-step process of legally shutting down an LLC in the Golden State. Look, whether you're moving on to a brand new venture, you're finally retiring, or you're just ready to close the doors, shutting down a business correctly is honestly just as important as starting one. We are going to take what normally feels like a total maze of legal and tax requirements and turn it into a clear, totally manageable process for you. $800. That right there is exactly why we're talking about this today. If you just stop operating your business, lock the doors, and walk away, the state of California does not just assume you're done. Nope. They will keep charging you a minimum annual franchise tax of $800 every single year, plus compounding penalties and interest until that entity is officially legally canceled. Just shutting down your daily operations isn't enough. You actually have to shut down the legal entity itself. So, to help you avoid those really costly financial traps, we've organized this explainer into a clear chronological roadmap. We'll cover 1. The hook and LLC basics, 2. The vote and preparation, 3. Winding up and settling, 4. Tax forms and mistakes, and 5. Final advice and disclaimer. All right, let's start with Section 1, Hook and LLC Basics. Let's just briefly ground ourselves in what an LLC actually is before we start dismantling it. A limited liability company is this fantastic hybrid. It gives you the limited personal liability of a corporation, mixed with the flexible management and pass-through taxation of a partnership. But here's the critical part. In California, LLCs are primarily governed by the Revised Uniform Limited Liability Company Act, or RULCA. It's the specific set of state laws that dictates exactly how we have to go about taking this thing apart step by step. Moving on to Section 2, the vote and preparation. Okay, so when you're ready to close, you really need to understand the difference between two terms that get confused all the time: dissolution and cancellation. Dissolution, that's literally just the beginning of the end. It's your internal decision and the active process of tying up your loose ends. Cancellation, on the other hand, is the very last step. It's the official legal termination of your LLC's existence with the state of California. So your very first practical step is cracking open your LLC's operating agreement to check for specific dissolution rules. Think of this agreement as your internal rulebook. It might say you need a unanimous vote, or maybe just a 2/3 majority to dissolve. Now, if your agreement is totally silent on this, California law steps in with a default rule, requiring a vote of 50% or more of the voting interest to dissolve. Make sure you actually hold this formal vote. And absolutely crucial here, document the decision in writing to protect yourself down the road. That brings us to Section 3, winding up and settling. Once that vote is passed, your business enters a phase known as winding up. This is where you handle all your final physical and financial obligations. State law actually mandates that you formally notify your known creditors by mail so you can start settling outstanding debts. And while it isn't strictly required by law, a lot of legal pros suggest publishing a notice in a local newspaper too. That just helps inform any unknown creditors and gives you an extra layer of protection against surprise claims later on. Now, let's talk about the money, because California has a very strict statutory hierarchy for how you distribute any remaining assets. Listen to this carefully. Outside creditors and debts absolutely must be paid off completely before any member sees a single dime, no exceptions. Once all the debts and taxes are completely cleared, then you can pay members any required interim distributions, return their initial capital contributions, and only after all of that do you distribute whatever is left over based on their shares. Be warned, there is a massive risk here. Imagine dissolving your business, taking your cut of the remaining cash, and then a year later, an unpaid vendor sues you personally. If you distribute assets to yourself or the other members without paying off those business debts first, your limited liability shield completely vanishes. Members can literally be held personally liable for unpaid business debts up to the amount they received. And get this, creditors have up to 4 years after dissolution to come after you. Always, always pay your creditors first. And that ties perfectly into a recent legislative update you should know about. Assembly Bill 1802 makes it crystal clear what happens if you accidentally discover assets after the company is already fully canceled. Even if the LLC is legally dead, the law treats it as if it still exists just for the purpose of distributing that newly found money. And that same strict rule we just talked about applies. Those late discovered assets still have to go toward paying off any unsatisfied creditors before they ever reach the members. Let's jump into Section 4, tax forms and mistakes. With the physical business bound down, it is time for the administrative paperwork. You have to systematically close out your accounts with secondary agencies. If you had employees, you've got to submit final payroll forms to the EDD within 10 days of quitting business. Sold goods, you need to file final sales tax returns with the CDTFA. You are also going to need to send a physical letter to the IRS to cancel your employer identification number. Oh, and don't forget to cancel any local city or county business licenses, too. Okay, listen up, because this is where a huge and honestly terrifying mistake is often made. To stop that $800 annual franchise tax we talked about earlier, you have to file a final tax return with the Franchise Tax Board. For an LLC taxed as a partnership, you're looking at California Form 568. You must explicitly check the box that says final and literally write the word final at the top of the form. If you miss this tiny detail, the Franchise Tax Board is basically tricked into thinking your business is still active. And those $800 bills? Yeah, they're going to keep right on coming. This brings us to the ultimate administrative step. You have to file the Certificate of Cancellation, known as Form LLC-47, with the Secretary of State. By signing this, you are officially certifying that all your debts are paid and all final tax returns have been filed. Just a quick note here. If your initial vote to dissolve wasn't unanimous among all your members, you'll actually need to file Form LLC-3, the Certificate of Dissolution, either before or right alongside this cancellation form. Now, there is a shortcut available, but it comes with some incredibly strict rules. It's called the Short Form Cancellation, Form LLC-4/8. It is strictly reserved for much newer LLCs. To even use this, your LLC must have existed for less than 12 months, it must have never conducted any actual business, it has to have zero debts, and you must have returned any investments to your investors. If and only if you meet every single one of those criteria, you can skip the standard process and use this short form. Finally, Section 5, Final Advice and Disclaimer. So, why does getting this process absolutely perfect matter so much? Because a sloppy closure is going to haunt you. Failing to properly dissolve leaves you with lingering financial exposure, meaning your personal assets could actually be at risk. We're talking compounding tax penalties from the Franchise Tax Board, endless compliance notices stuffing your mailbox, and potentially real damage to your reputation that could ruin your chances of securing financing for whatever great business idea you come up with next. And that leads me to a really essential reminder. Please remember that the information we've gone over in this explainer is for educational and informational purposes only. It's definitely not a replacement for formal legal or tax advice. Every single business has unique contracts, liabilities, and tax situations, so you should always consult a qualified attorney or CPA about your specific situation before you go filing any of these documents. So I want to leave you with this to think about. Are you fully prepared to confidently close your LLC and protect your financial future? Because by following this structured roadmap, holding the vote, winding things up, paying your creditors first, and filing those final correctly marked tax forms, you can make sure your business is put to rest the right way. Doing the hard work right now leaves you completely free, unburdened, and entirely ready to focus on your next great adventure. Thanks so much for joining me for this explainer.